Welcome to this explainer. If you're a busy financial executive looking to optimize your asset allocation, we know your time is incredibly valuable. So today, we're skipping the noise. We're going to give you a rapid, high-signal briefing on a sector that is quietly undergoing a massive structural transformation. We're looking specifically at the iShares U.S. Telecommunications ETF, ticker symbol IZY. Now, you might be wondering, why reevaluate telecom right now? For years, the broader market has made this persistent assumption about the telecommunications sector. It's often viewed as, a sleepy, low-growth utility play, a boring place to park your cash for a modest dividend, right? Well, that assumption is rapidly becoming a liability, and portfolios that cling to it might be missing out on an absolutely critical shift. Okay, let's dive into this. Here is the bottom line up front. As of May 2026, IYZ has delivered a massive trailing one-year total return of 46.49%. That is a staggering figure for a supposedly sleepy sector. It's significantly outperforming broader communication category benchmarks. Honestly, this kind of price action demands our immediate attention so we can understand exactly what is driving the surge. To respect your time, here's our roadmap for today's briefing. We'll cover the strategic investment case, AI factories and networking gear, fiber expansion and revenue stability, index methodology and concentration, and finally, sector risks and regulatory shifts.
Section 1. The strategic investment case.
To really understand IIZ's recent performance, we have to totally reframe the sector narratively. The legacy telecom model, that was essentially about consumer wireless plans and utility-like dividends. But the new reality is vastly different. Today, telecommunications represents the critical physical layer. We're talking high-speed switching, optical routing, and integrated connectivity. It's acting as the picks and shovels of the AI gold rush. I mean, think about it. You literally cannot build an AI factory without the plumbing to move the massive amounts of data. Section 2, AI factories and networking gear. Now, what's really interesting about this is IYZ's construction under the hood. When most people hear telecom ETF, they immediately think of wireless cell phone carriers. But look at that massive 45.71% allocation strictly to communications equipment. IYZ is heavily anchored in the hardware side of the equation. These are the exact companies building the physical networking infrastructure required for the 5G rollout and hyperscale AI data centers. And here is the direct result of that hardware focus. Consider the year-to-date returns as of May 2026 for three of IYZ's key holdings. Cisco, which is the fund's largest holding, is up over 53%. But the optical, networking, and photonic product firms, that's where the explosion is really happening. Ciena is up over 151%, and Lumentum is up over 161%. The sheer computational power required by AI processing means global data traffic is growing exponentially, and these are the companies providing the high-speed fiber optic connections to actually handle it all. Section 3, Fiber expansion and revenue stability. So how does the service provider side keep up? Well, it's happening through a critical industry shift known as convergence. U.S. telcos are no longer just mobile phone carriers. They are morphing into integrated connectivity hubs. By expanding their massive fiber optic footprints, they can actually use the exact same physical cables for wireless cell tower backhaul and to provide high-speed home internet. This dual-purpose strategy is brilliant because it dramatically reduces customer churn and increases the average revenue per user. And this brilliantly illustrates how the top carriers in the fund are executing this strategy right now in 2026. Verizon is aggressively pushing its convergence strategy with a huge target of 27 million fiber passings. AT&T is adding 4 million new fiber passings through its acquisition of Lumen's assets. Meanwhile, T-Mobile is leveraging its 5G lead to aggressively capture the home internet market through fixed wireless access, targeting 15 million broadband users by 2030. They're all trying to lock in the total consumer ecosystem. Section 4, Index methodology and concentration. Back in early 2026, IYZ shifted its benchmark to the Russell 1000 Telecommunications RIC 22.5/45 capped index. That's a mouthful, but the reasoning is simple. The U.S. telecom landscape has incredibly high barriers to entry, which leads to a natural oligarchy. If an index were purely market cap weighted here, just one or two companies would totally consume the entire fund. This specific capping methodology ensures the fund remains IRS compliant for diversification, while still allowing investors to capture the high conviction growth of the sector's absolute heavyweights. Even with those caps in place, the portfolio still maintains extreme concentration. Cisco sits right up against that cap limit at around 26%. Verizon and AT&T follow at roughly 11.8% and 10.2%, Add in Sienna and Iridium, and just 3 to 5 companies make up over half the entire portfolio. It creates this distinct barbell structure, balancing the massive high-growth technology infrastructure companies on one side with mature, high-yielding service providers on the other. When you compare IYZ to broader communication ETFs, its unique value proposition really becomes clear. Funds like XLC are much cheaper, with an expense ratio of 0.08%, sure, but they are completely dominated by social media and interactive media giants like Meta and Alphabet. If you want pure physical layer exposure, the little wires, switches, and towers, IYZ strips out those media companies to give you exactly that. On the flip side, alternatives like XTL dilute the mega-cap leaders through an equal weighting scheme. Let's move to and see how this builds. Section 5. Sector risks and regulatory shifts. Of course, it's absolutely crucial to note the capital intensity here. Carriers carry massive debt loads to finance these 5G and fiber rollouts. Because of this, the sector exhibits high negative sensitivity to rising treasury yields. When interest rates rise, the cost of servicing that massive debt jumps, which directly threatens their dividend yields and valuations. Plus, we have to be honest, despite the recent 46% surge, the 10-year annualized return sits at a very modest 5.05%. The early 4G and 5G eras were pretty brutal for capital expenditures. Beyond the macroeconomics, the legal landscape is shifting dramatically. Following the Supreme Court overturning the Chevron doctrine in 2024, the Sixth Circuit ruled in 2025 that the FCC lacks the authority to classify broadband as a Title II common carrier. So now, in 2026, broadband operates largely as an unregulated Title I service at the federal level. While this eliminates federal net neutrality mandates and drastically lowers compliance costs for telecom firms, giving them a lot of pricing flexibility, it also shifts the regulatory battlefield. States are now attempting to enforce their own individual rules, creating a really complex patchwork of local regulations that these companies just have to navigate. So, bringing it all together, the crucial takeaway from our source material is this. The telecommunications sector is no longer just your cell service provider. It is the physical backbone enabling the most significant technological leap of our generation. Understanding the convergence of high-speed switching, fiber expansion, and AI data demands is completely non-negotiable moving forward. So the question you must ask yourself as you review your asset allocation is this. Are you still viewing telecom as a sleepy utility, or does your portfolio reflect the massive physical infrastructure demands powering the AI revolution? Thank you so much for joining us for this explainer.